A draft red herring prospectus functions as an engineering schematic for a massive liquidity event, mapped out through hundreds of pages of legal disclosure. We are specifically analyzing the DRHP for INDO-MIM Limited. The cover page identifies the core mechanism of the transaction, a 100% book-built offer. Processing a document of this scale requires isolating the signal of capital flow from the surrounding legal boilerplate. First, we dissect the dual-engine capital structure, separating new corporate capitalization from stakeholder liquidity. Next, we trace the algorithmic waterfall, dictating exactly how shares distribute across the market. Finally, we examine the banking plumbing, designed to mitigate risk during the physical transfer of capital. This structural framework reveals how public equity markets are engineered to operate. Moving past the dense cover text, we can begin to isolate the underlying capital mechanics of the public offering. The details of the offer to the public table identifies two distinct capital events occurring simultaneously. The fresh issue represents 10,000 million rupees of new equity entering the balance sheet to fund corporate objectives. The offer for sale consists of 129.6 million shares, acting as a liquidity event. This capital bypasses the corporate ecosystem entirely, flowing directly into private stakeholder accounts. This dual structure balances the capitalization needs of the business with the exit incentives of early promoters. Most IPOs operate as this type of hybrid mechanism, facilitating founder exits alongside corporate growth. By identifying the selling shareholders, we can see exactly who receives the OFS capital. The weighted average cost of acquisition data point reveals the historical economics of these early promoters. For the corporate promoter, Green Meadows Investments, the acquisition cost was just 2.67 rupees per share. John Anthony Dexheimer acquired shares at 25 paise, while the Indian Institute of Technology Madras holds a cost basis of 0. The final offer price is currently an unknown variable that will be determined during the upcoming book-building process. The spread between these near-zero acquisition costs and the future cap price represents the realized alpha for early stakeholders. This historical cost basis provides a clear metric for the wealth generated at the moment of the IPO. Beyond the economic outcomes, the prospectus defines a mathematical distribution for the shares themselves. In a 100% book-build offer, the company must price and allocate equity without a prior public market to guide valuation. The net offer is the total pool of equity available to the public, divided according to strict regulatory tranches. 50% of the offer is reserved for qualified institutional buyers, or QIBs, to ensure institutional backing. Up to 60% of that institutional tranche can be allocated to anchor investors on a discretionary basis 1 day before the public bidding opens. A minimum of 15% is mandated for non-institutional bidders. This category is subdivided based on application size thresholds, above and below 1 million rupees. The final 35% is strictly reserved for retail individual bidders. A separate employee reservation portion may include a discount to encourage internal participation. This rigid stratification is designed to guarantee institutional support before retail participation begins. Processing this complex equity allocation securely requires a highly robust, specialized banking infrastructure operating beneath the surface of the offering. The application supported by blocked amount, or ASBA, is the mandatory mechanism for all non-anchor bidders. As defined in the DRHP glossary, ASBA ensures the bid amount is blocked in the bidder's account rather than transferred immediately. When a retail investor bids, they specify a bid amount for their desired shares. The bank executes the ASBA protocol by freezing that specific amount in the bidder's own account. This prevents the risks associated with physically transferring unallocated funds to a centralized escrow. The funds are only released following the formal approval of the basis of allotment by the stock exchange. Only then are the locked funds debited and moved to the public offer account. The ASBA protocol acts as the trust-enabling plumbing beneath the allocation algorithm, eliminating systemic refund risks. The carefully deconstructed DRHP document ultimately serves as the foundational architectural blueprint for the entire public offering ecosystem. We have analyzed 3 foundational pillars: the dual-engine capital flow between corporate growth and private liquidity, the stratified allocation waterfall that secures institutional backing, and the ASBA plumbing that secures the capital transfer. This document provides the data required to map the internal logic of an offering before trading. Every IPO is a highly engineered system designed to balance primary capitalization with stakeholder liquidity. Ultimately, the structural mathematics hidden within this prospectus reveal the actual mechanisms powerfully driving the global capital markets.